Hey, what's up, traders and investors, and welcome back once again. Good evening, Todd. How are you doing today?
Doing all right? Good morning, sir. How are you?
Not bad, not bad. It's, a little past this morning, but I think it's been one of those days for us. It's been one of those years with this market, eh?
Oh, man. But you know what? This is why we're in this.
That's
it's
right.
Fun. It's different every day. It's a big puzzle. We've got a lot to talk about tonight. It's going to be a good presentation. We've been working hard on it. I'm excited for this, man.
Yeah, it's been quite the interesting year in the markets. There's been a lot of news thrown at traders and investors, and we felt it would be a good opportunity to put something new in front of them, perhaps. And welcome to everybody in the room. Glad to have you guys on board with us this evening. Hope you're doing well, wherever you're tuning in from.
So here's the big question. Being that Bennett's in Texas and I'm in New York, upstate New York, way upstate New York. We have the Houston Astros playing the New York Yankees right now for the AL Division Series. The winner of this goes to the World Series. So, Bennett, I'll keep you updated here. We have probably an hour of content, and then we'll do Q&A. We have a lot of important things, and then I don't know. We'll see how the games go. But this is a big game. The kids are watching in the other room, and I don't know. We'll see if there's any Yankee fans out there. Let me know, guys.
Probably I'm sure we've got a few. I'm sure we've got a few. You know, I got to say I've been more of a football guy, but I'll take it if we can make our way into the series there.
Right on. All right, so just a couple minutes past the hour. You want to dive in here?
Take it away.
Let's do it. This is an important webinar. Bennett and I have been working hard on this. Obviously, the markets are going absolutely crazy. So there's a lot of them. There's a lot that we're excited to share with you. Want to make this interactive. Want to make this fast pace. We're watching the YouTube window in there. So questions, comments, insults, throw it right in there. Okay, and also if you don't mind, maybe post this up on Facebook. If you're on Facebook, Instagram, TikTok, I don't know how to do TikTok, but let people know that this is going on. I think there's going to be a little bit of something for everyone in this presentation. And again, there's a lot of people who are scared right now, rightfully so. It's been an unbelievable market. I think I saw something today. If we close this week, it'd be one of the third or fourth worst years in the stock market ever. And that can mean different things to different people, right? If you're a trader, it could be very good and there's a lot of opportunity. If you're an investor, it's pretty stressful. So we're going to try to talk to both, kind of put what's going on in this market in context and hopefully show you from our point of view, how you might be able to put some framework around it, understand where we are, where we might go, and how to move forward safely. So crash or correction, it's a big question. The Fed's liquidity fueled party, it's over. The question is a long hangover setting in, or is this just a short-term break before good times return? And is the Fed going to pivot? So let's jump in here. Disclaimer, this is important. Nothing that we say here should be construed as a recommendation to buy or sell. And this is important because I do now own a wealth management business as well as a research business. I'll explain that. So this is really just an insight into the way we look at the markets. And if you so choose to follow us and adapt our way of thinking, our approach to the markets, that's great. And really that's what this presentation is about how to take control of your own particular accounts using a certain school of methodology. So we're not telling you to buy or sell anything. This is really just us sharing our approach to the markets. And if you choose to adapt and accept the risk, that's great. Have at it. If this is not for you, please close the YouTube window, move on. Okay. You have to accept the risks before you move in any trade or investment. And it's really a good rule to live by. Okay. Don't trade with any more money you can't afford to lose. All right. So to start, Three questions off the bat. I want you guys to think hard about this. Are you concerned about skyrocketing inflation? And as a result of skyrocketing inflation, is the Federal Reserve behind the curve? Are you concerned? I mean, obviously, we know prices at the pump were sky high. They've come off. Prices at the register, at the supermarket, we know are ridiculously high. We know the Fed is raising rates very aggressively, and we've got more rate hikes to come. Has the Fed kind of lost the script? Number two question I'd like you to think about: does it feel like you're being assaulted, like from all angles, with a constant barrage of news? We live in the digital information age. I name my wealth management business New Age Wealth. Does it feel like, between my buddy Portnoy, who I've met a couple times, Reddit, Wall Street Bets, SPACs, NFTs, Robinhood, Dogecoin, like it's mind-numbing, everything that we just went through post-pandemic, and the Fed's response as well as the government's response, all these bubbles that have come and gone and popped, now the incessant calls for recession, depression, market crash, like it's enough to drive you crazy. Number three, does the current market correction, or is it a crash, as a lot of people are wanting to have you believe? Is it keeping you up at night? Does it cause you stress? Does it cause you concern? And everyone's answer is going to be different, and that's good, because you can have a 25-year-old, 30-year-old, on the stream tonight who's like, bring it. I love buying shares at lower prices for my longer-term portfolio, or I love trading. I'm in and out all the time. Or if you're 60, 65, 70, and you have retirement plans, is it concerning? Yep, I certainly understand that. We are fortunate enough between the two businesses that I'll introduce you to work with all kinds of clients from young 20s to late 70s. And everyone's answer to this is different. So we take our job very, very seriously here. This is a very, I don't want to beat this horse to death. But this is an important time, an important presentation, at least from our point of view, and we thank you for joining us. So, considering those three questions that I just asked you, again, three questions from the top. Are you concerned about inflation and the Fed? Do you feel like news is kind of distracting you, or perhaps causing you to make wrong decisions or emotional decisions? And do you think the adverse movements that we've seen, are they causing you stress? And looking at this little overlay, could we go lower? It's possible. Here's the S&P 500 from 2021 to now in green, overlaid on the GFC, global financial crisis. These are percent changes here. We could go lower. So how does that make you feel? Based on those questions, do you have a solid game plan for your trading account as well as your longer term investment account? I mean, do you feel solid, for however you approach the markets, trading or longer term investing? Do you have a tried and true and tested battle plan that when it gets hairy, when the proverbial excrement hits the fan, as it seems to do almost every day now, can you trust in that plan? Or do you think you're more emotionally reacting to the markets, following the news too much, or are you gambling? So I'm Todd Gordon, guys. Some of you know me, some of you may not. I'll give you a quick intro here, but the next 50 minutes, we're going to show you how to develop a trading and investing a plan according to our way that'll accomplish the four following critical parts. Trade not with IQ, so up here, intelligence, right? Mental intelligence, intelligent quotient, but EQ, emotional intelligence. Our job is to not outsmart the market, but to not outsmart ourselves and control our own emotions while exploit the emotions of the masses for our own gain. We're going to show you how to analyze the markets using a framework that helps to define and control your risk and reward for both kinds of accounts, short-term trading accounts, swing trading accounts, or your longer-term investing accounts. The methodologies, the rules, the guidelines that we're going to put in front of you can be applied on almost any time frame. And then lastly, I've already said it, how to filter the constant assault of us on news by media outlets and all these different organizations who are competing for clicks and advertising dollars trying to get our attention, which unfortunately works against our better interests and distracts us and causes us to make better decisions. Finally, within this trading plan that I think will accomplish these 4 critical parts, be prepared for either scenario, a market crash or a correction for the next bull market. What's going to happen? I don't know. No one can know. We can't know the future. Okay, that's not a lack of EQ, excuse me, that's not a lack of IQ, but that's showing EQ, emotional intelligence, knowing that we don't have to stress about what the future holds. We have to prepare in the now. So guys, stay until the end. Again, we're going to try to get to an hour of content. We have a very special gift that you really want to grab before you take off. Stay to the end. We'll send you home with a very key gift that basically is our game plan for how we're going to handle the end of this very amazing year, Q4. So listen, I think you guys are watching on YouTube, and as I said, this is important. We put a lot of work into this. We take this very seriously. So I ask that you please pay attention. You're on YouTube. There's probably 4 or 5 videos off to the right now that are looking pretty tempting for you to click on, maybe put us on a tab, listen to us in the background while you're watching another video with prettier graphics than we have. But please maximize the screen. I really appreciate it if you pay attention. Ben and I feel like what we have to say is very important, especially in this very, very busy market. So appreciate you doing that. Okay, so who is this? Why should I listen to you? I don't know how to put this. Okay, so if you don't know me, I am Todd Gordon. I've founded 2 companies, New Age Wealth, which is an RIA wealth management business, and tradinganalysis.com. So I've been in the business for pretty much even before I left college. I knew I wanted to be a trader. Went to the West Coast, traded professionally for a prop firm. Went to back east. I worked at a hedge fund as a trader and a senior tech analyst during the global financial crisis. I've been on CNBC since 2010. While at Wall Street, I worked for Gain Capital Asset Management. That was my last real job. As I said, prop traded right after school from 2001, 2005. Went to St. Lawrence. I was a Division I ski racer. I was a little bit more focused on ski racing, trading my E-Trade account in my dorm room, the social activities, and then probably 4th in order was my economics major. Bennett, I'm going to bring him in. You heard him at the beginning. He is basically running trading analysis. I've stepped away in the last 2 years, which is our research business. Bennett, he's the chief analyst at Trading Analysis. He's my right-hand man. He runs everything. Full-time trader, investor. I'll let him talk about himself in just a sec. But I'm going to go through his bio here. I'm going to bring him in on the next slide. Started trading at 22. He's a network engineer. He's a pilot. He's an amateur radio operator. He's trying to explain to me what this ham radio thing is. I still don't understand it. Bennett's a lot smarter than I am, which makes me, again, a business owner and a manager with EQ and maybe IQ. You always hire people smarter than you. Bennett, welcome. Thanks for running the show, Trading Analysis. You're doing an amazing job. Talk to us quickly about all these cool places you've been flying and maybe how it pertains to trading.
Yeah, absolutely. I'd be happy to. So one of the things, let me jump in here with you. What you're looking at there is just kind of a collection of sites that I happen to miss from California. There are not a lot of things I miss about California, but one of the things I most certainly miss is the scenery. We have 2 hours to the coast, 2 hours to the mountains, and I thought it would be fun to kind of show a little bit of what happens up in the air. We've got a nice trip over Laguna Seca there, flying above the clouds, and then of course the inverted picture. You can't forget the inverted flight. That's cool. Yeah, once you taste inverted flight, straight and level's just never quite the same.
I was going to cut you off until you said inverted. And of course, I was thinking it was Top Gun. Like, what were you doing? Flying upside down, just keeping up foreign relations. But you're underselling yourself. And, I think just the interest of time, I wanted to put in another slide, just talk about the similarities that we have. Bennett, obviously, with his pre-plan, with his flight plan, everything should be done ahead of time, because invariably something will pop up ahead of time or pop up in the moment, and then you have to react. Not different than, I would say ski racing days. There's a lot of time that goes into inspecting a course before you're going down there at 50, 60, 70 miles an hour. You have to have a game plan dialed in, and literally you spend 2 to 3 hours on the course ahead of time building that game plan, because when you are ski racing or when you are in flight, something will pop up and you need to be free acting on that plan. Your mind needs to be firing to adapt and take that variable into account. So I would actually say there's a pretty good similarity between skiing, piloting, and trading. Okay, so quickly, trading analysis. This is our research business. There's the team. I think we're 7 or 8 deep now. These are the public-facing guys, and then we've got a great team behind us who are making it run. So we're actually coming up on our 10-year anniversary. December 2012 was when the business was launched. So we're coming up on our 10-year. There's some of the team. We have 2 more that have joined us since that are integral. So, boy, how many do we have now? So I guess 4 plus 3 plus 2, 9. Wow. Okay. So when we're done, guys, I just want you to think again, levity aside, in this critical time with such volatility, so many forces working against the market, like, if you are stressed, if you answered yes to any of those questions, if your longer term accounts keeping you up at night, if you're not sure how to position your shorter term trading accounts, like, can you imagine what it would be like if you had a rock solid plan that you're comfortable with in the heat of the moment, when you're in battle and the market's going crazy? Like, one of the things I've seen training traders for the last 20 years is, when things get crazy or you have a couple bad trades, a couple bad investments, that's when you go indicator hopping. You go and you look for another indicator put on your chart, or you try a different methodology, go watch a YouTube video. Like, that's the worst thing to do. You have to have a rock solid game plan that you trust implicitly during periods of volatility. It helps you filter through the noise. So how do we get into this mess that we're in right now? Well, real simply, the Fed bought a lot of bonds, and they put a fancy name on it called quantitative easing. Began in the global GFC, global financial crisis, back here in 2008-9. Fed was carrying about $1 trillion, no big deal, 800-900 billion in treasuries. Then all of a sudden, housing crisis hit. S&P got wiped. They started buying bonds, QE 1, 2, 3, 4. And as they're buying bonds, they're suppressing interest rates to get you and I to borrow money, to buy stuff we don't need, and push the economy, or consumer spending economy, along. So basically, the Fed is buying treasuries, U.S. treasuries, and mortgage-backed securities, putting money in the system, taking bonds out, pushing bond prices up, pushing interest rates down, which is borrowing costs. Now, all of a sudden, the liquidity party, they say, is up, and they're starting to unwind the balance sheet, which means they're taking money out of the system, selling bonds, not buying back new bonds, and interest rates are starting to go up. That's why the market's selling off. We have a long way to go to unwind this balance sheet that began way back here. Inflation, because of quantitative easing, because of monetary policies done by the Fed, as well as fiscal, which is all the stimulus programs put out there by the administrations, both administrations, it was Trump and Biden, as well as a few other forces. We have inflation right now that's the highest since 1982. 8.2% here, CPI year over year. You can see it's been higher. It can go higher. Here's the 1920s. Here's the 50s. And then there is the 70s into the 80s. And you'll notice there's actually this little trend line there as a side note. So as interest rates have gone up, bond prices down, volatility is moving up. Stock market down, volatility is moving up. The big reason, again, this is a piece we snapped here. The stock market's in trouble because the bond market is very close to a crash. So again, what's happening is the bonds go down. Remember this from economics class. Bond prices are being sold off because the Fed's not buying them anymore. That's called quantitative easing. That's over. So as bond markets are going down, the corresponding yield on the interest rate goes up. So here's 10-year yields. Here's the 2-year yields. You can see them mostly trading together. And here's the S&P pushing lower as a result. Bank of America worried about bond market volatility and says risk of a crash is rising. If we do get interest rates pushing up, continuously going parabolic, it's going to pressure the stock market. I can say with almost certainty. So here's the stock market boiled down to the most simple terms. Will this NASDAQ, going back to that global financial crisis low on a log scale, just a real simple 1, 2 touch point uptrend line. Here we are again, testing right here. Will it hold or will it break? Does that question keep you up at night? What if I told you you don't need to know if support will hold? What if I said you don't have to worry about it? What if I said that you could be prepared ahead of time to figure out if we're going to hold support or we're going to break and we're going to fall lower? Again, would you like to set all the noise and news and other people's opinions aside and stop causing you to make emotional, poor investing decisions? And guys, what we're going to do here is we're going to show you to learn the same battle plan that we use for our own accounts and how we guide our clients at the research business as well as the money management business. So here's the one certainty I can give you after 20 years as a trader. The market's a big puzzle. It can be put together, can be understood. You can anticipate future price movements. And from that, you can define risk, reward setups that are favorable based on where you expect the market to go. And if it doesn't work out, you're going to have clearly defined points where you can put your risk. So the market, again, is just a big puzzle. Kind of put it together. And if you know how to look at it using a set of rules and guidelines that we're going to put in front of you, it starts to make sense. Take the basic patterns of technical analysis that probably you all know. We take it another step further and we assign expected starts and stops to them. We try to identify the patterns using the Elliott Wave theory. Again, they're traditional patterns that you all know, but if you have expected starting and stopping points, you have validation, invalidation points, you know when to expect these patterns. That's when the puzzle starts to come together. So people fear what they don't understand, hate what they can't conquer. Adam Smith, father of capitalism. Don't take my word for it. Let's hear from some heavy hitters, much more so than myself. It's my good friend Andrew Baptiste. He was the chief technical analyst at Morgan Stanley, JP, for a couple decades. And this is from Drew's mouth himself. The wave principle is a simple, rule-based methodology that allows the trader to dissect the collective mindset of market participants, which allows for defined, attractive, positive risk-reward trading. I used to be neighbors with Drew when we lived in Jersey. This is us down at his club in Florida. This is a private golf club in Florida, in Naples. Drew is he's a mentor. He's a dear friend of mine. Drew beats to his own drum. He played drums in a reggae band. He doesn't wear shoes a lot of times at the country club. And these are my twins, Jake and Brody. He's the best. Paul Tudor Jones, you should have heard of him, worth over $3 billion. He's donated over $1 billion to charity. I've been to several of his events in New York City. First year, Bruno Mars was the music. The next year, Paul McCartney was the music. If you've read the book Market Wizards, it's a classic in trading. Tudor is quoted as saying, has been so successful with Elliott Wave theory, allows one to create favorable reward risk opportunities. I attribute a lot of my own success to the Elliott Wave approach. There was a lost video in 1987 where Tudor was positioning using Elliott Wave as a main component to be short for the 87 crash. He was only 32. He made $100 million in 1987. And it's all on video, the lost Tudor video. He pulled in some pretty significant law firms to take it, strip it off the internet. I have a copy. But it's him using Elliott to be short for the 87 crash. Soros, out of the New York Times. As far as Soros is concerned, Prechter, who basically brought Elliott Wave theory back from the earlier 20th century into the later 20th century, Prechter we'll talk about. Soros is on record in the New York Times saying Mr. Prechter's reversal proved to be the crack that started the avalanche. So Soros is saying not only did Prechter help Tudor predict the 87 crash, but Soros is saying that Elliott Wave caused the 87 crash. Prechter denies it, and I talked to him about it. Prechter is a dear friend of mine. We worked together for a couple of years. He's been constantly bearish in the stock market. I would say this to his face. I love him. He's a peach of a guy. He's in Georgia, pun intended, but he's been wrong. And a lot of people assume Elliott is constantly a doom and gloom methodology, and we can have a longer discussion about that. We don't see it that way. We see it as a trading opportunistic methodology to assess multiple scenarios. Okay. So from there, guys, Bennett, I'm going to bring you in here in one sec. Okay, Bennett, I'm gonna hand the screen back over to you. From there, I think Bennett is going to take us into some Elliott theory. Get into the content. Enough of the mush.
Sounds good. Let's jump into it. Take it away. Take you through a little bit more about the Elliott Wave principle. Appreciate the intro there, Todd. And I will catch you in just a couple of minutes. Let's go full screen on the presentation here. Taking a look. So as you guys know, this year it's been a bit noisy, as you can imagine. And as a result, there have been many of you who have been a little bit lost, perhaps overwhelmed by the headlines. We've found that to be a very common theme with our clients at Trading and Analysis. So by the end of this webinar, my goal is to show you how you can filter the noise and how you can learn to go from reacting to the market to anticipating the market while actually simplifying your analysis in the process. And this form of analysis actually not only increased my profitability, but it also simultaneously decreased my level of stress and uncertainty in trading and investing. Because unlike traditional technical indicators, which are by design lagging, Elliott Wave is forward-looking and is also, or I should say, also comes with a set of rules and guidelines. So the methodology tells you when and where your trade or your outlook has been invalidated or validated. And if you've been following our mailing list, you perhaps have seen some examples of that. We're going to look at that in just a minute. So here's what you can expect if you decide to venture into the world of Elliott Wave. First of all, you will not be calling major market reversals in the first day, week, or month. And you're not going to see the light or the magic immediately. Maybe you will come away from this presentation having seen the light, but it often takes a little bit of time and investment, but anything worth doing is worth doing right. You will, however, learn to manage risk like a professional trader, and I find that to be one of probably the most important aspects to the Elliott Wave principle is the risk management capabilities of Elliott, and many overlook that when deciding whether or not to begin the journey into learning Elliott. And then, of course, you will learn how to anticipate markets and, of course, set yourself up for long-term success. And reacting to markets, obviously, in this environment can be very costly. And we're going to show you some examples of that in just a minute. And then the addiction disclaimer, you're going to be hooked for life, probably. It's difficult to put it down. Now, before we get started, just promise me you will not try to be a hero with Elliott Wave. And we find this, unfortunately, to be another common theme amongst new traders and investors who have a tendency to see every 5-wave move on a chart, and they think the completion of that 5-wave move is automatically going to result in a 50 or 61% retracement of that upside breakout. So what I've done here is I put together just a little example to show you the fractal nature of Elliott and the fact that really it's by design one of the most bullish forms of market analysis. And looking at this chart, we're taking a look at the chart of Shopify. I'm not sure if you can actually see my mouse on the screen here, but this is obviously split adjusted pricing. From $2 back in January 2016, the stock rallied in 5 waves up to $17.66. Now, what's interesting about this trend is Elliott Wave combined with Fibonacci suggested that high would come in north of $16. That 5-wave move, however, as you're going to see, was just part of the trend. And there's usually a larger trend at work. You can see that sequence that we just went through here, that 5-wave completion ultimately occupied and made up a higher degree wave 1 position That gave us a sideways consolidation, and the stock ran up to north of $150 a share. So just know that oftentimes there's going to be another mountain on the other side of that valley. So just keep that in mind as you consider whether or not to jump into Elliott. So in addition to showing you how you can go from reacting to the market and the headlines to anticipating the market and the headlines, I'm going to give you my 3 secrets, the top 3 secrets to anticipating markets. And it really starts with secret number 1, and that is indicators are useless. We hear it over and over again. What indicator set should I use? How do I interpret, insert indicator name here? Just stop. Here's a fun chart showing a ton of trend lines, a ton of retracements, all sorts of indicators. And the joke, this meme chart has been going around the financial industry for quite some time. The joke is, oh yeah, I found the bottom, can't you see it? So just know that indicators are by design lagging, and they're not going to set you up for success, nor will they help you to go from reacting to anticipating markets. They just tell you what you already know because they are by design lagging. And here's a good example of had one used a very common indicator, the relative strength index, on a 2-week time frame of the S&P 500. Let's imagine, for instance, you were out of the market through the credit crisis sell-off in through the 2009 low, and you decide that you're going to buy the oversold conditions in the S&P 500. That would have produced a 71% return, as you would have then likely sold the overbought conditions there out of January of 2011. Unfortunately, you would have missed out on the massive returns offered in the Wave 3 position. You would have had 1, 2 more sell signals before you were ever presented with a, quote, buy signal from oversold conditions. So therefore, you would have essentially taken advantage of the first and the last part of the trend while missing the heart of the breakout, which is unfortunately something we find quite common with indicators. We can find indicators that are in overbought conditions for many weeks, if not months. So let's just start fresh here. If this is what your chart looks like right now, if you have your MotiveWave window or TradingView window or Thinkorswim window open, and this is your chart, just do me a favor, delete them all. By the end of this webinar, you should not need them. Secret number 2, the news. The news, unfortunately, is almost always late. Sometimes it's wrong, and when it's accurate, it's already priced into the market. And so, although many find it difficult to accept, trading with the news and opinions of the financial media and many of the social media influencers, many of which Todd was mentioning at the beginning, is kind of like trying to drive by looking through your rearview mirror, and that's so true. When you go back and you take into consideration, let's say, a major market development and how the market cycles correlate with or around the news cycles. Let's show you an example of exactly what I mean by secret number 2, and the news is already priced in, and the fact that by doing away with lagging indicators, we can see those major pivot points coming well in advance. So what we're going to look at really quickly before moving on is an S&P chart. We're looking at a weekly time frame. We're going all the way back to January of 2018, which, by the way, we consolidate, break out into September. We had a 2941.91 intraday high. I'll never forget that print. That gave us a pullback into December of 2018. And here's where the magic really starts to come into play. Coming out of the December of 2018 lows, and you'll notice there are no indicators on this chart. We're looking at open, high, low, close price bars without color, no candlesticks. And you'll notice here, going into the summer of 2019, the S&P 500 had been consolidating at or near the September 2018 high. And when viewing the market through the lens of the Elliott Wave principle, it suggested that the S&P 500 was gearing up for a breakout to what we were looking up to 3,300. So from 2894, viewing the S&P through the lens of Elliott said we were on our way to 3,300. You'll notice as we move into the next chart, we ended up at 3391, I believe was the high just before the coronavirus sell-off. But what's fascinating, as I'm sure you can all see, the coronavirus sell-off was already on the chart well before the world even knew the coronavirus was a thing. And you can even see here in this chart, we had anticipated the summer 2019 breakout to yield a move up, and then yield a move all the way back to the December 2018 lows. Now, when the coronavirus came along, it set the social mood up for a more significant decline, and we ultimately broke the December of 2018 lows. However, this was on the chart well before it ever occurred. And then secret number 3 is all you need is in fact the chart. Using Elliott Wave allows you to trade ahead of the news as you can anticipate future price movements. And let me show you one other example of how you can use clearly defined pivot points, or as we referred to them earlier, validation or invalidation levels, to determine and anticipate where the market might be going. And this is actually from our email in August going into September of this year. We had identified, first of all, going into August, an expected pullback. And here in the case of the NASDAQ 100, we had provided you all with a key level. That level was 12,175.98. Why that's important, I'm going to show you in a minute. But when viewing markets through the lens of the wave principle, you are provided with clearly defined confirmation objectives, if you would. And so what this chart told us before the news cycle, or before the headlines, or before the August CPI print came about, this chart suggested that in the event the NASDAQ 100 broke south of 12,178.98, that we would be going to new lows. In fact, I even said in the email here, under 12,175.98, and we are going to new lows, mark my words. And that is, fortunately, thanks to the powers of the wave principle, which we use to filter the noise. So before we continue on, what on earth is Elliott Wave? Perhaps you're unfamiliar with the wave principle and you'd like a little bit more information before moving on. It's simply a form of technical analysis that we use to identify patterns that exist and repeat in financial markets. And unlike traditional technical indicators, which are by design reactive and lagging, Elliott Wave is predictive, and it includes a set of rules and guidelines. So it takes the emotion out of the equation, and the market, the chart, the hard right edge tells you when and where your trade setup is invalidated. And why is this important? Well, it's important because in the world of Elliott Wave, there are only 2 classifications of developments. We have directional waves, and all directional waves do are start a larger trend. Corrective waves go against an ongoing larger trend. So the question that we need to answer for 2022 is whether or not the decline in the major market indexes is a directional wave or if it's a correctional wave. And that's what we're here to talk about, and that's what the Elliott Wave principle can do in times such as, or environments such as the one we find ourselves in now, with many mixed opinions and unfortunately many variables outstanding. Therefore, the outlooks are quite uncertain. So in the case of directional moves, very simple. Directional waves are 5 wave trends, meaning they unfold as 5 waves, and they start a larger, more significant, higher degree, if you would, trend. It may sound confusing, but it simply suggests that directional waves will start a larger trend and that they're going to end a larger trend. And correctional waves obviously just go against the ongoing directional wave. So here's an example. In the case of the S&P 500, a 5-wave trend is going to be corrected in waves 2 and 4 with one of the only 3 Elliott Wave corrections. That's right, there are only 3 corrective waves and patterns within the wave principle. So who on earth discovered the madness, the voodoo that is the wave principle? And that's none other than Ralph Nelson Elliott, born 1871, unfortunately passed away in 1948. He began his career actually as an accountant, specializing in railroad build-outs throughout Mexico and South America. In 1924, however, he was actually commissioned by the U.S. State Department to be the chief accountant of Nicaragua. Unfortunately, a short time later, he became sick. He was confined to his home, and he began studying the 1932 book, The Dow Theory. And that's when he began to discover that financial markets would trend in reverse in recognizable patterns, and he began to compile his observations in what is now known as the wave principle. And at the age of 64, believe it or not, many don't know this, he actually launched a new career. He moved back to New York and he began managing wealthy clients' capital. His prominence grew in New York City. He ended up with offices at both 25 Broad Street as well as 65 Wall Street. So, more importantly, how do we use Elliott Wave today, and how can it help you to filter the noise in trading and investing? And I'm going to show you the 2 primary ways in which we use Elliott Wave here at Trading Analysis. And the first way that many overlook is identifying and managing risk. And this is a really awesome example, I feel, going back to a low in the stock of AMD. And what we were looking at here, notice again, there are no indicators on this chart. This is simply pattern recognition by viewing AMD through the lens of Elliott. And what you'll notice here, remember going back to our discussion about directional waves unfolding as 5-wave sequences. Here we can see a move up, bottom left-hand corner of the chart, from a major swing wave low, translation from a major low. We have 5 waves up in 1, back in 2, up in 3, sideways in 4, up in 5. That gave us a 1, 2, 3 wave consolidation or correction. From there, we do it again, 1, 2, and that is when the trade setup came into focus. We were able to anticipate the breakout in AMD. We were also able to simultaneously identify and isolate our risk because we knew that per the Elliott Wave principle, in the event AMD were to break south of $82.21, it would invalidate the uptrend. So what that essentially equates to is from an 86 handle area entry per the stock, not an options trade, but just per the stock alone, we're looking at 13.2% of reward to our upside target and 4.29% of downside risk. So as you can see, it consistently offers favorable and positive reward risk opportunities. And if you can see this in the top right-hand corner of your screen, you'll notice that we ended up taking a position here on June 24th, right into the Wave 2, coming out of the Wave 2. We kept it simple. We picked up a 3-point call spread, paid 90 cents. That gives us $2.10 of max profit. And as you can see in the next chart, that's exactly what AMD did. We started to take profits on the 30th at about 110% return. So in at 90 cents, out at $1.90. The risk was clearly defined. The emotion, we could separate ourselves from the emotion, and we were able to anticipate the breakout thanks to viewing AMD through the lens of the wave principle. Another fun one, looking at the chart of Tesla. This is a great example of a corrective wave, a 3-wave pullback in a stock. And in this instance, we were looking at April 14th area resistance around 780. And looking at this chart, Elliott Wave suggested that that zone would result in a 5-wave trend to the downside. And as you can see in the next chart, that's exactly what unfolded. So very simple. Here's a 5-wave trend to the downside. That starts a larger trend. In this case, it just started a 3-wave move. We had 3 waves back to correct the directional trend, another 5-wave sell-off. Here's a fun one going to a different asset class. We're now looking at cryptocurrencies, and this is tracking the final decline in December of 2018, believe it or not, when, first of all, I have to take a step back. Before the chart of Bitcoin broke south, it was consolidating near 5,000. And many within the financial community had expected the 5,000 handle, or excuse me, the 5,000 handle in Bitcoin to act as key support. And the reason they expected that to act as key support is at the time, the actual mining cost per one Bitcoin was right at around 5,000. So they expected in the event Bitcoin broke south of that support level, it would result in the end of the network as we know it. Viewing Bitcoin through the lens of the wave principle, again, we don't see any indicators on this chart, just pattern recognition, defining our risk based on the rules and guidelines of those patterns. The chart of Bitcoin suggested that it was gearing up to actually complete a sideways consolidation, tap trendline resistance, and Elliott Wave combined with Fibonacci said we were on our way down to 3,100. Now the actual low was, I think, 3128, depending on which exchange you used. And as you'll see in the next chart, we went from that little green or orange D wave, as you can see, right up into resistance, and we started our journey south towards 3,100. Next up, let's take a look at Bitcoin going back to April of last year. April of last year, many were expecting the move through 60,000 to automatically yield a breakout to 100,000. Our chief macro and crypto analyst, Alex, who does a fantastic job, was on top of this third wave. And as you can see here, Elliott Wave suggested in April of 21, when Bitcoin was trading just south of 50,000, that Bitcoin was on its way to 18,000 to 22,000, by as early as January of this year and as late as June. And as you'll see in the next chart, we had an initial 55% sell-off. We ended up retracing back to the highs, and we met the 18,000 downside target into June. And then, of course, we can't forget the fact that Elliott Wave predicted, or at least was able to identify, anticipate the coronavirus sell-off well before we even knew coronavirus existed. And as you can see here, just to follow up the summer 2019 consolidation, here's a chart of the NASDAQ. And in the case of the NASDAQ, we were also in a sideways consolidation that we expected was a corrective wave and would yield further upside in a 5-wave trend. So you essentially have a directional wave, a correctional wave, and another directional wave. But here's a consolidation that was in effect from before May of 2019 through October of 2019. Notice the date in the bottom right-hand corner here. This is October 11th, 2019. And then look at the top here. This is October 11th, 2019. Todd came out viewing the NASDAQ through the lens of the wave principle and was able to identify the breakout on the horizon, positioning in advance, anticipating that breakout there in the NASDAQ. And then most recently, the August 2022 resistance zone, which has been really a fun one. If you've been following our work and you've been signed up to the mailing list, we were walking you through this one. Here is an example of a clearly defined pivot point in the case of the S&P. And I'm going to show you this. I'm going to illustrate this for you, but I'm going to break it down in a very basic fashion here. When it comes to 5-wave moves that only start and end larger trends, when it comes to 5-wave moves, there are certain rules associated with them. And one of those rules suggests that the wave 4 and the wave 2 corrections, and let's jump over here. The wave 4 and the wave 2 correction should be clearly isolated, meaning if you are moving, from the bottom left to the top right, you have up in wave 1, down in wave 2, up in a wave 3, down in a wave 4. You should have clear separation and isolation between your wave 4 and wave 2 positions. So what that means is that in the event you see that trend or those waves overlap, it invalidates the structure. And in this case, it actually confirmed the fact that the summer rally was a corrective wave. So here we can see from the June lows, we have a move up, a correction, a move up. From there, which by the way, viewing the summer rally through the lens of the wave principle, we were able to establish a short position in the S&P about 45 minutes or an hour before the top occurred. But as you can see here, we had identified 39.45 as the bear trigger point. And in our emails, and as Elliott Wave suggested, if we broke south of that level, we would automatically be on our way to new lows in the index at 36.36. Here we can see once that bear trigger occurred, we met our downside 36.36 target. So still not convinced. We realize there are many skeptics of the wave principle. We are clearly firm believers in utilizing it as both a trading and investing methodology. And as you can see earlier, and as you saw earlier, we're in good company. So again, why does this matter? Why are we here today? And we're here today because this has been a very busy and noisy environment, and unfortunately the headlines have been misleading for years. Here's a headline going back to October of 21. This veteran analyst hears echoes of the 29 crash in today's stock market. Here's one from this year, October 13th. Someone is betting that the market will collapse. Back to another one here. A 47-year market vet explains why he sees the economy's super cycle hurtling towards depression and lays out his case for an 80% plunge later this year. You notice anything strange about that last article I just showed you? It was posted April of 2020. What was the market doing in April of 2020? Let's take a look. Here's that chart of the S&P. Elliott Wave in the summer of 19 said it was going to break out to 3,300 and sell off back to the December 2018 lows. It got 33.93, so 93 points above the upside objective, no big deal. And it moved all the way back to the December 2018 lows. And then after that significant haircut in the markets, we get a move up. We retrace about 50% of the sell-off, and the financial media comes in, hits you hard with the 80% market collapse on the horizon. And you can see here the arrow where I have drawn April of of 20. And of course, instead of selling off 80%, the S&P rallied 70%. So Elliott Wave saw the breakout. Elliott Wave saw the pullback. Elliott Wave, as you can see here, anticipated well before the news cycle was on top of it. So this is an instance where, and this has really been in effect since September of 2018, rather. Many very intelligent investors have missed out on massive returns due to the market uncertainties. And so with what we've learned tonight, the question on everyone's mind, and really the question that's going to determine where this market goes, is whether it's a motive or directional wave, or is it a correction? Is it a 5-wave move that starts a larger bear market, or is it just a 3-wave garden variety pullback that's going to result in a move to new highs? Prices exist, as we discussed, in one of two forms: directional waves and correctional waves. And so Elliott Wave is the only form of technical analysis and market analysis that is forward-looking and that can anticipate that decision before it occurs. So we're here to help you guide. We're here to help guide you through that decision, and of course, equip you with the tools and knowledge to learn the wave principle if that's what you're here to do. And then, of course, I'm sure you have all seen this chart. This is a chart showing the overlay of the 2008 credit crisis and the current market in white. And unfortunately, the correlation has been quite remarkable. We can see here an overlay of the current view of the market on the left with an overlay of the market then in 2008. And as we can see here, so far, the market has done 5 waves down, it's done 3 waves up, and it's done 5 waves down. So that tells us that we are at or near the completion of 3 waves down. So right now it's a correction. If this is going to morph into or ultimately materialize into a larger bear market, only Elliott Wave can answer that question and really reveal the true underlying collective sentiment of the market. So before handing it back over, let me take you over to some live charts. And what I want to show you here is just a breakdown of what we're going to be watching with our clients over the next couple of weeks. So again, right now we have 5 waves down, 3 waves up, and 5 waves down. What does that make? It makes a 3-wave move. This would suggest then that the low from October 13th, Thursday, when the S&P broke the 3,500 handle and had the 4th largest percent move, intraday percent swing, I should say, in the index's history, that low might actually mark the end of the correction. If that doesn't mark the end of the correction, we could have one more push down into support near 3,400. But the more important market decision on the horizon that we are here to help guide you through, and that Elliott Wave can help to squelch the noise, filter the noise and the information flow, is whether or not this is 5 waves down or 3 waves down. It's as simple as that to me as a technician. And as you can see here, last but not least, if this is truly a 5-wave move down that is going to be a bear market, then instead of this being just an ABC corrective pullback, we're now going to see the S&P deliver a corrective retracement. And if it delivers a corrective retracement and starts to poke back to the lows, things could get a lot more interesting on the downside. So if you're interested in Elliott Wave, again, we have the tools and knowledge to help you shorten the learning curve. If you're interested in having us help guide you through the upcoming volatility, we would absolutely encourage you guys to check us out. So that's what I've got for you guys this evening. Let's jump back over here. We'll bring Todd back in. I've got his screen share. Got your screen share coming your direction.
Good job, bud. That was excellent.
Thanks, Todd. Appreciate it.
Very good. Why don't you take a sec, just look at questions, comments before we move on to the next part of the presentation. Just make sure everyone's good.
Absolutely. Happy to. Yeah, Modern, you bring up a really excellent point, and I right now would say that is likely what's happening in the market. We'll be going live again tomorrow to talk a little bit more about that. Hey, if it comes to it, I'll jump in the plane. I'll go for it. There was a comment about if we go to war, they're putting me in a plane and sending me into
I
battle.
saw that in the B-2 bomber.
Yeah.
That's funny. All right, so what did you guys think? We have a kind of a next part of the presentation. I'm sure that brought up a lot of questions. We're going to do some live charts. We're going to look at the market here. We've got a couple positions going. We'll show you that. But again, really, really good job. Let me just get up the questions here. We're laughing ahead of this presentation. The real reason you have multiple screens as a trader, not for trading, but when you're running a trading business to keep everything organized here. All right, so I think you guys could see that we have, I would say, not a typical way of going about the market. We're not going to tell you for a second that it's super easy, and then you can just plug in an indicator. Bennett just pulled apart all the indicators. I'm curious what you guys thought about that. But we work hard at it. We're passionate about it. We love working with our customers, our clients, and we firmly believe self-education and hard work can make you a significant amount of money. So I think the key takeaway is you don't need to predict the future, but you do need to assess the now completely. You need to have a set of rules and guidelines and repeatable process to assess what's going on, to put yourself in the best position to benefit from what may happen down the road. So you don't need to stress about the future. You need to stress about today. You need to stress about having a good game plan to go into, especially when the markets get crazy. So I like Tony Robbins. I take whatever your opinion may be. I think he puts out some good work. And he says anticipation is the ultimate power. Losers react, leaders anticipate. So enlightenment, trade with a plan. You have to have a plan. For us, a major part of the arsenal in terms of trading our own accounts, how I run, I run multiple millions of dollars on the wealth management side. This methodology is a key and core component of my approach for managing the longer term portfolios as well as the shorter term money. So using Elliott and Fib, we have expected starting and stopping points of both trend and corrective waves. Like, how nice would it be to know if we're in a trend or correction? Rest easy, trade with higher EQ, right? Emotional intelligence. Control those caveman tendencies. We didn't talk about it in this presentation, but our brains are basically hardwired from the caveman days to get all puffed up, filled with adrenaline when we're faced with uncertainty, like trying to position our money at risk based on what might happen tomorrow, next week. And basically those old tendencies, I would say our primitive brains before they developed some of those features kick in when we are trading, and we need to learn how to block that out. So block out the noise, embrace that you can't know the future, and you don't have to. Stop wasting energy on it. You'll have the confidence that you're heading into a plan trade. And our motto at Trade Analysis is plan your trade, trade your plan. So go to the next level. Have to be trading with a plan, guys. You have to have plan A. And if plan A doesn't work, then you have to have plan B, right? It's a contingency plan. The way I look at the markets and how I've impressed on my team is it's a big conditional statement, right? You don't need to know what happens in the future. You don't need to waste energy on that. It's an if-then statement. If A happens, then do B. If C happens, then do D, right? And you do so, and you move forward, kind of feeling your way through the maze, through the puzzle. And as you put capital at risk, whatever your time frame, you have points of ruin, points of confirmation, and you want to make sure that invalidation points are smaller than how much you expect the market to move in your favor if you're correct. Built-in profit targets know when to ring the register, exploit the emotional masses. People spend more time planning their vacations than they do their portfolios. People are way too plugged in to the news right now and to their social media influencers, and they're making decisions based on emotion. And you can use that to your advantage. So introducing, we do have a course. Bennett has recorded a wonderful Elliott Wave training course that I do want to offer to you tonight called Elliott Wave Fast Track. It's the latest edition of our e-training series. We've been doing these for about 8 years now. Trading analysis was one of the early adopters. So in the course, we break down, simplify, apply powerful concepts of Elliott and Fib, kind of start from the basics and then build on it. It's obviously a powerful methodology. It's used by some hedge funds, some analysts that cover the hedge funds. I learned Elliott Wave from 4 analysts who work for the investment banks, one of which was Andrew Baptiste. Another one was a guy named Jim Chorick who worked for UBS. And this is when I was trading at the hedge fund. And this is, not the retail brokerage arms, but these are the global heads of technical analysis for the banks. And I spent a lot of time on the phone with Jim Chorick, and he said one thing to me I don't mind telling you right now. He said, be careful with Elliott Wave. It can be rather addictive to almost like the bad joke he would make. It's like kind of addicting like crack. It's hard to put it down once you pick it up. And I would say that was 2006 and 2007. And so far that's been true. So stop guessing, risking valuable capital on substandard setups while suffering from indicatoritis, or as Bennett said, just blow them up. So this is the course, Elliott Wave Fast Track. It's a new e-learning experience. It's launched, it's live, it's interactive, it's recorded with high def, quality video, quality audio. It's built in the latest technology for e-learning, which again, trading analysis is ahead of the curve. So here's the what it is. It clarifies Elliott. Why? So you can predict price change rather than react, especially in today's incessant barrage of noise coming at you. We have live mentoring and updates that will come with this package, so you can see this working in real time and in your account live. Real-time Elliott Wave analysis, you're going to look over the shoulder of our professional team that's going to shorten your learning curve and save time using, again, this high production quality training course. And you have ongoing support. We have a big staff at Trading Analysis. We have an active community and Discord that is all more than willing to step in and help you. So you have a lot of resources to make sure that you stay on track. Excuse me. So the Elliott Wave Fast Track, again, it's introduction to Elliott Wave. You look at the core patterns, you look at motive waves, you look at corrective waves, you get inside of both, you figure out where you want to be positioned, where you want to be out. This is good for options traders. This is good for stock traders. This is great for crypto traders. Any trading market has tips, tricks, and how to apply in the real market. Bennett spent a ton of time putting this course together. He did a really, really good job. Proud of it. I think you will certainly see the value. So it's $497 course. It's 5+ hours. Plus we're going to have an extra bonus. So it's going to be probably 7-8 hours of training. One particular part, Bennett, do you want to kind of walk us through? This is one part, I think part 2 we pulled out here. One of the core patterns. Do you want to talk to this?
Yeah, that was, if you'll go to the next slide, what I was pointing out there is, in lesson number 2, we actually cover this very topic in terms of what we are considering in the markets, whether or not this is simply just a 3-wave correction to the downside, or whether or not this is going to turn into a larger 5-wave move for a bear market. So I felt it was a good discussion, given the fact that that's exactly the pattern that we're looking to either confirm or dismiss right now.
Yeah, nice. That's super important. Are we, is this corrective, or is this part of a larger downtrend? And that's kind of our main mission right now. And one of the earlier charts that Bennett showed that he had the short on in Tesla. This is in fact that exact pattern. So in part 2 of the core pattern, 52 minutes into the lesson, there's a lot going on here. Don't be intimidated if you're kind of new to this. You will go through a learning curve. As I said, we'll try to shorten it to the best of our ability. You'll be indoctrinated in, but that's the kind of stuff you're looking for here. And these are the kind of turning points that you should come to expect, not all the time. You're gonna have winning trades, you're gonna have losing trades. But again, when I started out on this, and I'll tell you the story here in a little bit, how I got started with Elliott Wave and how it changed my trading. I'll tell you here the story in just a little bit, but you'll see turning points that no other methodology can put out that I've seen. And I've looked at everything. I've been doing this for 20 years now. But wait, there's more. So after you complete the course, we're going to invite you in to our full service, our premier service. So this is basically our flagship service, TA Premier. Stock option trade alerts, nightly videos. You get weekly sector rotations. Another methodology that we use to look at the markets, headed up by Terry Long, who's on our research team. We haven't even gotten into that. Weekly member webinars. You get the mobile app. You get our app with push notifications when we put actual trades on. All of us, we put trades on with real capital. I'll show you my positions here. So you get access to this for half of a month. We're going to give you this for half of a month. So within this, we cover, Bennett goes into in-depth analysis with Elliott Wave, analysis of the S&P, the NASDAQ, the Dow. We look at the major macro markets, plus there's real-time trades that are going out with full explanation in the member video based on the methodology that we introduced to you tonight. Private chat, mobile app, 5 nights a week video. There's more content than what you want. That's than you can imagine. That's a look inside the members area. And wait, there's more. So besides the fast track course, besides being invited into the member premier service for 2 weeks, we're going to do a all hands on deck, very important members only premium event, November 3rd, 8 p.m. Eastern Standard Time. Why are we putting a big push on this right now? I don't know if you guys know this, but this is the 35-year anniversary of the 1987 crash, right? So this is a pretty important, critical time. October is an interesting time in the market, so we're keeping everybody very much updated here. Okay, so aside from that, we do have a trade desk that gives specific entries and exits for all the positions that the team is putting on, and it is updated in real time, no after the fact kind of stuff. All right, so let's put it all together. So you have the Fast Track Interactive Learning course. You have it lifetime access, so you can go back and rewatch it as many times as you want. The Q4 Master Market Plan, which I haven't shown you yet, that's going to be a download that I'll make available to you. $297, 14 days of the Premier service, which is valued at $88. Plus, you get the live members November 3rd session, valued at $97. So next week, altogether, this would be offered at $980. For the promotion tonight, we're going to do it for $200. So $200, you get all of that, and that'll take you in well through Q4 of this year that many people would like to forget. Hopefully, you're not one of them, and hopefully it's one that you'll remember fondly, but maybe not too late to turn it around. So here's how you take advantage of this offer. You go to tradinganalysis.com/now. Let me just make sure that link works. I know it does, but let me just show you tradinganalysis.com/NOW. And that should bring you to this page right here, Elliott Wave Fast Track Premier, $200 right there. And you can fill out the information right there. Okay. So again, what do you get? The interactive learning course. Clients have been through it. I asked Bennett to get some testimonials together. He dropped the ball. Bennett's a wonderful Elliott Wave analyst. He's a wonderful communicator. He's incredible with his time to the members, but he's lousy at sales. Sorry, Bennett. I love you. You're not lousy. I know. I'm joking.
No worries.
Your focus is guide the members. You're doing an amazing job. So interactive learning course, the Q4 Master Market Plan, which we'll show you how to get a hold of. 14-day trade analysis access to the service. Then you get invited to the members only, all hands on deck Q4 strategy session. That'll be November 3rd. just under $1,000 value right there. It gets you out the door for $200. So go jump on it. If you have any doubts or any confusion about where you are in the market right now, how you're going to handle this going forward, and really what you're doing. So we're going to take this offer down. It's got to come down. We can't leave this out there forever. We'll leave it up until Saturday night at midnight. If you have any questions, I don't think Nick's not working now. Call him tomorrow morning. We have a team on the phone ready to stand by and help you with any questions, access, whatever. 855-WIN-TRADE or info@tradinganalysis.com. Our customer service is spot on if you have any issues there. So tradinganalysis.com/now. Okay. So that is going to be the main part. Now, if you want to get a hold of our Q4 battle plan, we'll give it to you as a gift for free. And that's this guy right here, Q4 Master Market Plan. Basically, the team wrote out how we're going to approach the market from a technical and Elliott Wave point of view heading in for the rest of the year. So you'd want to go to tradinganalysis.com/gift. And that is yours for free. So it should be tradinganalysis.com/gift. Yep. 2022 into 23 Elliott Wave cheat sheet market count. Put your name, your email in there, and you will be able to download that sheet. Okay. Let's take a look at, just to kind of show you some things in terms of, this is a course I did on Fib, for example, and just looking at some of the feedback that we've got from our training courses. All right, this is, again, from a Fibonacci training course. Todd, I completed the course last week, probably the most comprehensive and easy to follow Fib instructional material I've ever seen. Can you help me out? Can you help me put this material to work with Elliott Wave? I'm starting to study, so on and so forth. More feedback that we've gotten from the course. Great course. Thanks for your information. Todd, I feel the way you presented these lessons was easy to understand. Many lessons I watched more than once until I could answer all the quiz questions. A lot of good feedback. Since taking the course, I've earned back twice more than the price. It's helped me focus on setups and projections that Fib provides. Although I had some familiarity, I look forward to remaining live sessions. The only constructive criticism I have would be that some of the questions early on didn't seem to be straightforward. Having the question, the correct answers to view after several tries was a good safe fail, allowed me to proceed. Perfect. Thanks again for the course. So here's a recent Fib course that we did. I sent out a survey saying how satisfied were you with it. We didn't get any low marks. Everything was very high quality or high quality. How likely do you recommend to a friend or colleague? I guess anything left of 0 would be negative, which means we suck. And then anything right of 0 is positive, as we're good. So we had a net plus 64 NPS, net something. I don't know what NPS would stand for, but that's good. How would you rate the value for money of the Fib Mastery course? Excellent to above average, no negative responses. How likely to purchase any of our products again? Extremely likely, very likely, somewhat likely. More Fib Mastery feedback. Okay, so that is just a sample, and Bennett did a wonderful job again for Elliott Wave Fast Track. One more time, and then we'll get into some live stuff. We'll take some Q&A. We'll plot some charts. I've got a bottle of red here. Maybe we'll jump into that. So again, one more time, Elliott Wave Fast Track, interactive learning, Q4 Master Market Plan, 14 days of the TA Premier service. You'll be invited to the members only strategy session. Take us into the end of the year, which I don't think is going to be dull. Altogether, $1,000 value for $200. Okay. I mean, that's pretty much the price of, you get, I don't know. I think it's a no-brainer. TradeAnalysis.com/now. And this will be up until Saturday night, and then we're taking it down. Okay. Bennett, what do you think?
Sounds good, man. Excellent work. Good presentation. We've got some good questions coming in. Good feedback. Appreciate it. Thank you. Thank you. Kevin had one.
Very good. Very good.
Kevin had a question there for you if you want to jump in chat. Yeah, Modern.
Yeah.
Welcome to the club. Once you get bit by the Elliott Wave bug, it'll be with you forever.
You know, and that's one of the things. There's so much that we could put in. Like, I had so much content. Bennett and I were trying to keep this under an hour. Bennett and I could go for hours with this stuff, as could the whole team at TA. You know, one of the biggest things too is they say is it's too subjective, and I think that's really funny because show me, and I'm really asking, show me a methodology that is not subjective. Show me a methodology that's works that's objective, right? So, you know, I've got a slide. I didn't put it in here, but, you know, which moving average do you use? Do you use the 13, 21, 55, 50, 89, 133, 200, 252? Like, what moving average do you use? Now, a trend line. Like, how do you draw a trend line? What is the right way? You know, which swing points, high and low, should you use to connect the trend line? And once the market comes down to a trend line, are you supposed to buy it? Or are you supposed to wait for it to break down and short it? Like, I've only been doing this for 2 decades. I'm 43. I started trading when I was 18, professionally when I was 22. I don't know the answer to that question. The answer that I do know is it's all subjective. Anything that's worthwhile is subjective unless you have billions of dollars of computing power and you're Jim Simons of Renaissance technology, and you can run quant, whatever. Bennett knows more about this. He was a network engineer. Unless you have billions of dollars of infrastructure who knows how to really write systems and adapt those systems and implement them, like, it's all subjective. And your job is to be the best at interpreting what's happening now, have a tried and true way of interpreting the market, have, you know, guidelines and sets and of tendencies and rules that you use. And, you know, it's all subjective. Fundamentals are subjective. Interest rates going up. Like, okay, like if you read most economic textbooks, fundamental textbooks, you know, interest rates going down is supposed to be bad for the stock market, right? If bonds are going up, it's supposed to be going into a deflationary environment, which is bad for stocks. Interest rates going down, bonds moving up, flight to quality, supposed to have stocks go down. Right now, the markets would kill for lower interest rates. So sometimes interest rates going up are good, and sometimes they're bad for stocks. Strong economic data. We're in an environment now where strong economic data is bad for the stock market. Okay, well, that makes sense. Right now, we want an environment where the jobs data, in fact, the worst jobs data that comes out is better for the stock market. So, guys, it's all subjective. Elliott Wave is subjective, but all analysis is subjective. Elliott Wave gives you, again, a framework. It gives you expected locations of the traditional patterns that we showed you. It shows you when to expect them, where they should hold support, where, you know, if the pattern fails, where you have to reassess, which means manage your trade or manage your investment or make a move. You know, it gives you a lot more context than anything else out there that I've ever seen. And yeah, it's not formulaic. It's not A plus B equals C. It's if A happens, do B. If C happens, then do D. That's trading and investing with EQ, which is emotional intelligence, which means I know I'm not smart enough to predict the future. I just know I have to control my own emotions, follow my game plan, not make dumb moves, and observe and exploit the masses who are not as prepared today as you and I are. So I'm curious what your thoughts are on that, Bennett. Anyone in the chat, please push back. And again, any questions, we can look at some live charts, free form, anywhere you guys want to go with this. One more time, Bennett, throw up the screen. Yep. So one more time, those of you who didn't get that written down, tradinganalysis.com/now, and I'll write it in the YouTube window for those of you who want to jump on board. Bennett, back over to you.
Very good. Much appreciated. I was just dropping the link in there now. Yeah, regarding the
Cool.
subjective nature of the wave principle, as you mentioned there and illustrated quite well, there's really are no forms of analysis that are not subjective. And really, I would say that the wave principle often offers objective levels that no other form of analysis can, such as the pivot point we had in the NASDAQ and the S&P, where we were able to say new lows are on the horizon.
Yeah. Did you show that? That was a pretty ballsy call, and that was pretty awesome. Did you actually?
I did.
Did that
Yeah.
make it in the presentation?
Yeah.
Okay. That was really good. Yeah. So, what about markets you want us to look at, guys? Questions? Let me just pop this up. I closed the YouTube window. Net Promoter Score. Thanks, Alexander. I appreciate that. Mel, welcome. Let me see. Who's jumped in there, guys. If there's charts you want Bennett to take a look at, pop them in there. One thing, and I'll pop on my trading platform. I had some hedges on. I had some NASDAQ shorts on in the NDX, and I did just cover them. I can show you guys that from my point of view, where the market is. But if you want to give them a quick little analysis where you think. No, you do it.
I covered
show
that.
Us where you.
Yeah, I covered that at the end. I was going to hit it as well at the end of the webinar, but I did touch on that earlier.
Yeah, jump in there in the S&P.
Sounds good. Let's grab the screen here. We'll keep your audio on with us in case you want to join along. Okay, so let's hit this here. We'll take a quick look at the S&P, and I really wanted to first take a step back, and I'm going to just delete everything on this chart. I think this would be fun. So I'm going to just erase the wave count. And I'm going to show.
Did you say to erase the indicators, not the wave count?
This is true. We're going to rebuild the wave count. We're not going to rebuild the indicators. So looking at this market, okay, I think we can all see that we have what can be counted as 5 waves. And this is a little bit of a different type of 5-wave move, but we essentially have a trend wave down. This is a directional wave, so not a correction. This is a directional wave. And what did we learn about directional waves? Well, they simply start larger trends. So in this case, we are suggesting that 5-wave trend wave is starting a larger corrective wave. So therefore, we have 5 waves down in a wave 1. This wave 1 then gave us a move up in through the summer. What's interesting about the move up in through the summer is there was actually the possibility at the time that the correction ended in June. And here's where the magic comes in, okay? So there were 2 levels, 2 lows within the indexes that many were expecting to be the end of the 22 decline. The first one obviously occurred February 24th. The second one occurred in June. So from the February low, viewing the S&P through the lens of the wave principle, if one were to say, you know what, that 5-wave motive or directional wave, which we all just learned starts a larger trend, we're going to imagine that maybe this is starting a 5-wave move. So it's a 5-wave move that starts a bigger 5-wave move. Okay, if this is the case, as we learned, we know that our wave 4 and wave 2 positions cannot overlap. In a traditional directional 5-wave move, we cannot have overlap between those wave 4 and 2 positions. So what this told us when viewing the S&P through the lens of the wave principle, independent of any indicator, is that as the S&P broke south of 4416 into April of this year, that confirmed that the move up was not a 5-wave trend, but it instead was just a correction. So what that means is this first 5-wave move up, which remember, 5-wave moves start larger trends. Instead of it starting a 5-wave move, it just started a larger A, B, C. So what ended up happening is the market came down. That level, when viewing the market through the lens of the wave principle, that level simultaneously served as uptrend invalidation and downtrend continuation. So we knew when viewing the S&P through the lens of the wave principle that into the April low, that the move under 44.16 confirmed that this was a correction. So what that told us to expect a move now to new lows. Then we get into the June lows, and we do it again. We have 5 waves up. Okay, 5 waves can make a higher, a larger 5-wave move, or it can start a larger 3-wave move. So we have this up as maybe 1, down in 2, up in 3, maybe down in 4, and up in 5. And we knew that going into mid-August of this year that the markets were entering a major decision. And this decision, as we discussed in our email, was the opportunity. This is where the market had the opportunity off of the August high to either confirm the idea that the summer rally was a 5-wave move starting a larger trend, which would suggest the decline was over. And we also knew that alternatively, if this 4th wave were to go below the high of wave 1, that would, just as it did back in April, serve to simultaneously dismiss the uptrend and confirm downtrend continuation. So what ended up happening here, as you can see, even our MotiveWave platform is squawking at us to let us know that, hey, that is not a valid 4th wave pullback. So what happened into September is that a break under 39.45 confirmed the idea that this rally throughout the summer was simply a corrective wave. So what happened is 5 waves up made a 3-wave move. 5 waves up started a larger 3-wave move. And this is where, in the emails that Todd was mentioning, I boldly came out and suggested that a break under 39.45 in the S&P and a break under 12.175 in the NASDAQ would yield new lows. And I was only able to do that and see that and anticipate that move thanks to the wave principle. So this is the exact same setup as we had in April. We confirmed this as corrective, new lows are coming. Confirmed as corrective, new lows are coming. You'll notice one final characteristic of this trend that is quite interesting before I jump back over to Todd. After the market invalidated, it retraced between 50 and 61%. After the market invalidated, it retraced between 50 and 61%. This is something that we would not have been able to pick up on if it weren't thanks to the wave principle. So what do you think, Todd?
Yeah.
What do you think?
I think that's you've been very kind of dialed in on that, and Bennett, as we were going through kind of laying out our approach to this presentation, if you hear what he's saying, he was like, if basically he's treating it like a conditional statement. If A happens, then we're going to do B. If C happens, then we're going to do D. Right? Once he hit the invalidation point, of the would-be corrective wave, you're like, okay, then it's not a corrective wave, and we're set to, we have an idea of where we're going to go. If you're not in the right position, there's no reason to deal with denial, or pain avoidance, and not adjust your trade or adjust the position or adjust your portfolio to get in the right position. So it's not a forecasting methodology, right? We consider it a trading methodology. I think Elliott Wave is pretty lousy at forecasting where we're going to be at some point in the future. I think it's one of the best trading methodologies out there, and especially for you options traders out there. I was trying to kind of piece together, I had an NDX put spread on to sort of hedge my longer term positions. And I'm looking at my trade tabs, and there's just too much going on here in Thinkorswim to pull it together in a nice cohesive way. But we, in the members area, like curious before I get into this, like how many of you in the room are options traders? Like how many would you say, like what percent like are you trading options versus stocks? And then if you don't mind, just in the comments, like, are you longer term stock? Are you shorter term stock? Options? I'm kind of curious to know what what you guys are most interested in. But I had a longer term NDX put spread on, and I can show this to you. But this is sort of a longer term look, and I just tweeted this. We are kind of moving into longer term support. So Bennett throws me the screen. This is pretty good support on the NASDAQ longer term on the monthly. So this is a very, very basic wave count. I showed you the uptrend line here. We have 1, 2 touch point, and then the first real test of the trend line was here in September. And this is interesting. If this is in fact wave 1, this is 2, 3, and I'm not saying this is 4, but it could be. And using the guideline of Elliott, it's not that often that wave 4 is such a simple little move here. It's very possible that this would be the first wave of 4, and then this is going to be A, then we're going to go into either a triangle, a flat, or a complex. But the fact remains that as we get down to lower time frames, as Bennett showed you earlier, there are several different wave counts to suggest that we're at a low and a bounce is coming. But what's particularly interesting about this support point, not only that we're at trendline support, but it's also a fib relationship compared to the wave 2 drop here in 2007 and 8. So this wound up being about a 55% drop in the NASDAQ. 55 is actually a fib number, a fib ratio, which fib goes with Elliott Wave. And then this is what's kind of crazy is you go 55%, and then if you put that golden ratio into it, multiply it by 0.618 is 34, which is actually another fib number. Well, if you look at the current correction here in the NASDAQ, height of the current position, and you look at a percent basis right here, we're at 34% drop. So it's this 61% relationship, and this is how fib and Elliott come together, is understanding the price patterns that you'd expect to see, and then you then have the starting and stopping points using fib. This is where you start to formulate support zones and say this might not be the low, but there's a chance that we are going to hold support here, and we could start to move higher, which you can see the daily chart here. We had a big gap down on the 13th, okay, last week. Huge, I think that was one of the largest intraday swings in a long, long time. I don't know if it's on record, but I think it was like a top 5 intraday swing for the Dow. Open to the lows, close to the highs, and then we've been higher ever since. Today was a little bit lower, but we are starting to hold this support zone. And I had NDX shorts on, and again, I'm happy to show you here. NDX. I'm just showing you these trades in this particular account. That's Spotify. That's SPX. I don't know, somewhere in here. I didn't do a very good job setting this up. Oh, this is backwards. Sold vertical. Anyway, not doing a good job this one. We'll come back to it. But point is, being that this is a 5-wave move right here, as Bennett was showing you, down into support, this is just a short-term daily, right? And then you have that longer-term weekly and monthly. You have a 61% relationship versus the 07, 08 decline, plus the uptrend support. Plus you have a potential 5-wave move down. And plus, this is what Bennett was talking about with indicators. Guys, I'll bet you right now, I'll bet you all who's still left in the room, free access to the Elliott Wave Fast Track course. 9 times out of 10, when you have a good 5-wave, like a 5-wave move, there's going to be indicator divergence. This is where indicators tell you what you already know. So again, I'll bet everyone who's still in the room, if there's not RSI, and I don't know this, I'm not setting you up. If there's not indicator divergence here, I'll give everyone free access. Here's the RSI. Oh, look, there's indicator divergence. We have the low momentum reading as you would expect in wave 3. RSI makes a higher low as wave 5 makes a lower low. And we're now starting to push higher, relieving very oversold status in RSI. So, that's the kind of stuff, we're looking at. And then kind of in closing, the one thing I would say for closing is the volatility that you're seeing here is not done. There's an indicator that I like to look at longer term, and it's really cool on Thinkorswim. It has this available. It's called APTR, average percent true range. And we're looking at the Dow going back to 1905. So here's the 29 crash. And basically this is average true range, but it's normalizing it to look at percent swings. So I'm looking at 48, right? So this is a monthly chart. So the last 48 months, right? 4 years. So what's the average month over month range on a percent basis? What happened here in closing is in 2016, 14, 15, and 16, you look at the low reading on the monthly APTR. The range in the Dow was one of the lowest in the last 100 years. Month over month, percent realized range, which is volatility. It was similar to 1965, and it was similar to 1954, right? And if you scroll this, so here's 1954, market moved up. 1965, we went into a pretty significant sideways move in the stagflationary 70s. What is this very low realized range in the Dow going to do? Is the market going to sell off and the range gets back up to overbought readings, which is 8 or 9% realized month over month, 8 or 9% range on the Dow month over month, right? Right now we're at about 7%. We have more to go. So the question is, are we going to have continued reversion to the mean with volatility? It was very easy to trade and invest, and I would say more so invest back here in 2013, 14, 15, when the range, the realized volatility was dropping. This is when I have a whole other presentation here. The whole debate about active management versus passive management really got going. And, the Vanguard CEO, it was on record saying pretty much right here that active management is dead and passive management is the only way to go. Well, that was right at the realized volatility lows when we started really getting very busy in terms of ranges. It's continuing to mean revert. We're not overbought in terms of ranges. Higher ranges means more volatility, which means you got to have a game plan. You got to be dialed in. It's not just buy and hold in simple low realized vol markets like this, where everyone can make money. Okay. It's a new market. So again, in closing, one more time, let me just get you that link. You're going to go to, got so many windows open right here. Let me find this guy. Okay. So again, it's tradinganalysis.com/now. Go get it if you're at all interested. If you're a little confused but interested, I would say perfect. That's exactly where you need to be. Bennett did a great job with this course. If you'd like to figure out how to get in there, understand Elliott, how to apply it in real time, join us for the next couple weeks. Be involved in our strategy session. Get involved in the TA Premier service. Get the app downloaded, get the push notifications, jump in for only $200. Okay. It's a no-brainer. Bennett, great job. Guys, hit us up. If you have any questions, info@tradinganalysis.com. Again, the link, tradinganalysis.com/now. Thank you, guys. Appreciate your time and attention. Bennett, great job.
Appreciate it, Todd. And
cheers.
See you guys all in the next live stream. Thank you for joining us this evening. We apologize for going over, but appreciate you guys sticking with us. Todd, get some rest, sir. See you in the morning.
You too, bud.
Thank you, guys.
See you in the morning.
We'll see you on the next one. Take care.